Okay, today we are going to talk about management. So I want to start going through the various different organizational formats, and I want to diagram and explain kind of the differences between them, primarily between partnerships, corporations, and LLCs. Just so you have a general idea on structural differences, management differentials between the different types of business organizations. So I'm going to diagram this out. You guys can just stay on page 7, and we're just going to work our way through from sole proprietorship over till we get to LLCs. So the first type of business organization format is a sole proprietorship. And as we've already talked about, I'm not going to spend a lot of time on it. The sole proprietorship is the default type of a business entity involving one person. By definition, if you have more than one person, you don't have a sole proprietorship. So more than one person, you're going to be either one of the types of partnerships, a corporation, or an LLC. We'll get into those more later on. It is also the default, and what I mean by that is if you don't properly organize as one of the other type of entity structures, you automatically default back to being a sole proprietorship. This can also apply if you fail to renew your business. So if I set my business up as a single member LLC and I don't pay my renewal fee back to the Secretary of State each year, I may lose my LLC status, which means I lose my limited liability because I become a sole proprietor. So when you're a sole proprietor, it's one person doing business on their own, and it's really just as simple as that. Now you may or may not need to register your name, but if you're going to use an assumed business name, you will have to register that with the Secretary of State. All of your taxes are done on your own individual form, and we'll get into tax forms next week, so I'm not going to spend time on that. I want to get more into the partnerships and the different types of partnerships and how they differentiate from each other. So the most basic type of a partnership is a general partnership. A general partnership is the default form of a business structure when two or more people are doing business together. It is created automatically. And what I mean by that is even if you didn't really want to create a partnership, but you and another person or a group of people are engaged in an activity with the intent to make money on a more than a going concern, then you are automatically going to be deemed or be a partnership, a general partnership, unless you organize as one of the other forms of business. Now the reason why I highlight that is as a general partnership, you have unlimited liability for anything that happens arising out of the general partnership. That means that your personal assets are at risk. It also means that you potentially are liable for the actions of your other partners that are in the scope of the partnership. And this is a big problem with general partnerships. We don't like general partnerships because of the liability concerns, and it's again a situation where you may not even have intended to create a general partnership, but one happens automatically. Now I'll give you an example. Let's say we have a family that has a beach house, which they rent out for a vacation rental. And the parents owned it, and then the parents die, and it goes to the kids. There's 4 kids. All 4 children are on the deed to the rental house, and they inherited from their parents. And they rent it out, and then they just split the profits up on their individual tax returns. They don't form a limited partnership or an LLC. It's just all 4 of their names on the deed. That's a general partnership. They don't even think about it. They just say, hey, we'll split the rent each month, and you file it on your own. You file your taxes, I'll file mine. But there's a partnership there. Now, the scary part is if somebody gets hurt at the vacation house and sues, all 4 of them are responsible for that. So if my brother's down there with all his rowdy friends and somebody gets hurt, my brother's there, but I still get sued, even though I wasn't even there. So that's one of the big problems with a general partnership is you have this unlimited liability, and there's no barrier, no liability shield to protect. Now in terms of management and taxes, so let's say we have a general partnership here, and we have two partners, partner 1, partner 2, these general partners. So assume they're each 50% owner. Okay, so in a general partnership, again, there's no liability barrier between the business and the individual owner's assets. You are fully responsible and potentially face liability for any actions arising out of the partnership. From a tax standpoint, the profits of a partnership are going to be split based upon the percentages of the partners. Every year they will have to file what's called a 1065 tax form, which we'll look at in more detail in another class. That is a partnership tax return. And if you're a calendar year, you usually have to file that on March 15th. If you're a fiscal year, it would be different. But all percentages or all of the profit is split with the partners. Now the other thing I want you to know about a general partnership is that, right here on page 7, all partners have management authority. Now what that means is a general partner, and whenever you see the term general partner, I want you to think of two things. Number one, unlimited liability. If you're a general partner, you have unlimited personal liability. I also want you to think, whenever you hear the term general partner, that they have management authority. The idea of a general partner, when I say management authority, is the authority to make day-to-day decisions, to write checks, to engage in contract making and sign contracts, to get credit on behalf of the partnership, which may be loans or credit cards. So hiring and firing, filing of taxes, that is management authority. And one of the disadvantages of a general partnership is a general partner, you may have multiple partners, all have management authority, meaning they have the ability to sign contracts, enter into credit transactions on behalf of the partnership. And it may be that the other partners don't know about it or even agree to it, but the bank or the credit company can rely upon one partner's signature to bind the others. And that, there are some exceptions to that, but that can create, massive problems. And so that's one of the reasons why you also want to set up as one of the other organizations, so you don't have this problem of general partners engaging in those type of transactions without the knowledge of the others. I'm not going to spend a whole lot more time on general partnerships just because they're really a disfavored form of business, and it's really, you want, if you're going to be in a partnership, you want to be a different type of partnership, or better yet, an LLC. So with that said, let's start moving over to the other forms of business, because that's where I want to spend more time. And let's start talking about the limited partnership and limited liability partnerships. So starting with limited partnership. Okay, so limited partnership. Right here. The idea behind a limited partnership is to create a form of business entity that allows for essentially investors, who are the limited partners, to be able to invest money into a business endeavor of some type, and to have the ability to limit their risk to the value of their investment, but not their personal assets. This is a very old form of business. I mean, this goes back to ancient Greece and really derived out of maritime law with ships, and where you would have investors that would put money into a voyage, hire a crew and a captain, and to buy supplies, and then to buy cargo, and then they would split the profits out of a voyage. And the idea was, in order to be able to attract investment capital, you needed to provide the ability of an investor to limit their liability, so they're not afraid that if something bad happens, their personal assets will be at risk. So a limited partnership is the form of partnership that's sometimes called a silent partnership. You may have heard that term. And the idea of that is we have two roles that exist in a limited partnership. One role is that of the investor. They're putting money into the business or other assets. It may be real estate or a trademark or a copyright, an invention, or whatever. They're investing in the business. And the idea is that as a limited partner, they will have a shield from liability. Their maximum exposure is the value of their investment. Their personal assets will not be at risk. They will be sheltered. The other role is that of a general partner, who will be in charge of managing, down here, the business. So the reason why we sometimes say it's a silent partnership is the idea the limited partners cannot engage in management. All management has to be done by the general partner. The limited partners are solely investors. So let me give you an example. I'll draw this out here for you. So let's say we have a limited partnership here. And let's say each limited partner, the investor, is going to put in $1 million. And in exchange, they are going to have a 30% share of the net profits. So they are limited partners. So let's say they're going to buy, that's an apartment building, okay? let's say there's 50 units in the apartment. It doesn't matter, it's just for an example. So the limited partners are going to put in the money. They're going to buy this apartment building for $3 million with the investment that is being made. Now they need somebody to manage the apartment building. So they're going to hire a manager. They're going to give the manager, an apartment down there at the bottom. And the manager is going to be in charge of, interviewing tenants and entering into contracts with tenants and maintenance and upkeep and collecting the rent, paying the bills, and all that stuff. So the manager is going to be a general partner, and let's say they're not going to actually invest any money, they're going to do all the management. And in exchange, we're going to give that general partner a 10% share of the profits. So the limited partners are investors. The general partner is the manager. So the way that a limited partnership works, there is a liability shield that is created by the limited partnership. So let's say, for example, somebody comes to the apartment and they're walking up the stairs and one of the stairs is all rotted out and the stairs break and they fall down and are horribly injured. So let's say there's now a $5 million lawsuit. $5 million lawsuit. So what's going to happen? Well, the building is worth $3 million. So they're going to take the building, it's gone. That leaves $2 million left. And let's say maybe there's another $1 million of insurance, which leaves $1 million after payment of the apartment and the insurance, right? So there's still $1 million that's owed. Now, they're going to try and go after the limited partners to get that money. The limited partners will have a shield, and so they won't be able to access the personal or other assets of the limited partners. They are shielded. They lost their investment. That's gone. But that's the maximum exposure that the limited partners have. The general partner, however, has unlimited liability. The general partner will have to pay that $1 million if they have any assets. So whenever you see that term general partner, I want you to think, again, unlimited liability and management authority. The idea behind this limited partnership, again, silent partnership, is also this. The limited partners, by making an investment and getting that liability shield, give up the right to manage. That's the trade-off. And the idea is they're solely going to be an investor. They're not going to engage in management authority. And that's why they have a shield. The idea and theory behind that is if you are the one making the management decisions, you are also going to be responsible for those decisions by having unlimited liability. If you're not the one making the decisions, you put your investment at risk, but that's the maximum extent of your exposure. And so you give up the right to manage by getting that liability shield. So this is why, again, it's sometimes called a silent partnership, because the investors have to be silent. They cannot engage in management activity. So they can't vote on what color to paint the building, or who to have as a tenant, or who to hire to fix the roof. Those are all decisions by the general partner as part of the role of being a general partner. Now, a general partner is going to have, may not even have a percentage of ownership. That may be paid on an hourly or some sort of contractual basis or something else. The general partner may also be an investor with management authority. So it just really depends on how you structure a limited partnership. What I primarily want you to understand is this idea of a limited partner cannot engage in management. The general partner manages. In exchange, the limited partner will have a liability shield, whereas the general partner will not. Now, with that said, what if we have a limited partner that is engaging in management? Even though they're not supposed to, they are doing it. This happens, right, real world. I mean, you make $1 million investment, you probably want to have some say in what goes on, right, real world. And so, if it can be proven that the limited partner, or all of them for that matter, were actually engaged in management, hey, let's not fix the stairs this year because we want more cash flow. And they all voted on that, and maybe there's an email chain that shows that. Well, now, a judge can rule that they lose their status as a limited partnership and are converted to a general partner, and then they have personal liability. So that's one of the problems of a limited partnership from a management standpoint, is typically, if you're making an investment, you want to have some management voting rights. But you can't in a pure, strict limited partnership environment, because only the general partner has management authority, where the limited partners don't. So let me give you an example. Let's say, again, we have the beach house example. We have 4 children that inherited from their parents a beach house or a farm or whatever. It doesn't really matter. Now, they don't want to be general partners because all of them will have that unlimited liability. So they say, okay, fine, let's go ahead and organize, and we'll make our beach house a limited partnership. And we're going to appoint, one of the siblings to be the general partner, and the other siblings will be limited partners. Well, the problem now, these siblings can't vote on anything. And this sibling has all the liability. Now, maybe their percentage of profit will be the same, 25% each or whatever, But that's not really a great structure for a family-run business, because you have some of the family members have no say in the business, and you've got another family member or two as general partners that have unlimited liability. So it's not really an ideal structure. It is a very old structure, as I've said. We do see them still around. They are still used. Limited partnerships can also be publicly traded in some cases. And that, it is an area, especially historically before we had limited liability companies, which solves some of those problems, and I'll get to that later. So we do still have them left over from, historically. See this a lot in real estate type development, especially large commercial, like a shopping mall or something, where you'll have investors and then you'll have a manager of the shopping mall, or an oil and gas, mining, forest type activities. You'll see a lot of limited partnerships where you'll have the investors, and then you'll have the oil company or the mining company or the timber company be the general partner. So they are around out there as well. But the main idea I want you to know for this class is this inherent problem, and that is you cannot have management authority as a limited partner. If you do, you lose that liability shield. So on my page 7, under the limited partnership column, general partner manages. Limited partnerships cannot, I should say, shall not manage. They're prohibited from engaging in management, or they may lose their protection. So that brings us to the next type of partnership, and that is an LLP, right here. LLP stands for Limited Liability Partnership. And in a lot of ways, it's similar to a limited partnership, but in another way, they're very different. So let me just kind of explain the basics of how a limited liability partnership is broken down. Okay, so now we're going to have an LLP, Limited Liability Partnership. So let's say in this example, instead of an apartment building, we're going to have a medical clinic. We're going to have doctors. And the doctors want to get together and open a medical clinic where they will practice together. They'll hire employees, they'll get the equipment, all that stuff, right? Now they want to go in together because they want to be able to split overhead. Operating a medical clinic by yourself, very expensive, very capital intrusive. And so the doctors want to split up that overhead cost. But as a doctor, your major risk is what? Malpractice, right? A doctor messes up in surgery or doesn't prescribe correctly. So if let's say we're all doctors, I don't want to be responsible if you mess up a surgery or misdiagnose a disease or incorrectly prescribe a drug, and you're going to get sued for malpractice. I don't want to be liable for that. So we can't be a general partnership, because then we would all have liability for all the doctors. That would be horrible. We don't really want to be a limited partnership, because we also, as doctors, want to be able to vote on the clinic operations. What equipment to buy, who to hire as a manager, who to hire as nursing staff or physician's assistants, physical therapy, all of that. What color to get, carpet, all that kind of stuff. So we all want to vote on the clinic operations, and we also want to share in any income that comes out of the clinic. If we ever sell the building and it appreciates in value, we want to be able to share in those profits from the real estate increase in value, but we don't want to risk the liability for each other's individual medical malpractice. Now, that's the idea behind an LLP. They're primarily used in service industry. So medical clinic, dentists, lawyers, stockbrokers, accountants, financial planners, service type insurance agents, service type industries. And the idea was a form of business that allows for the benefits of management and sharing of profits like a general partner, but also having limited liability like a limited partner in certain circumstances. So let me break it down for you how this works. So let's say we're going to have 3 doctors. So we'll have doctor number 1, doctor number 2, and of course we're going to have Dr. Evil. Right? Dr. Evil. So here we have the clinic. So let's say each doctor is going to be a 1/3 owner of the clinic. On the clinic side, they're going to split the profits 1/3 each. They're also going to be able to vote on anything involving how the clinic itself operates. So what color to paint the building, when to put a new roof on, who to hire and fire, all that kind of stuff. Now, for purposes of the operation of the clinic, they will be considered general partners. Now what that means is they have unlimited liability for any lawsuits or debt arising out of the clinic itself. So if a patient shows up and trips over the doorstep and falls down and gets hurt, they're going to get sued for a slip and fall. So they are going to be personally liable for the clinic claims and liabilities. And that's not great. However, it's manageable. You can manage those risks by getting insurance, and those type of risks are not nearly the level of exposure that you would have in a medical malpractice situation. So while it's not ideal, it is better than a general partnership or a limited partnership because they get to manage and vote. They do have exposure, but that can be managed through insurance and that kind of thing. Now, on the other hand, we don't want to have malpractice liability. So for purposes of malpractice, they will be considered limited partners. And what that means is each partner's agreed is a liability shield. Each partner's individual actions as a doctor, either in surgery or prescribing medicine or whatever, each doctor will be responsible only for their own personal liability in practicing of medicine. So if Dr. Evil is engaging in weird experiments and stuff and gets sued for malpractice, the other doctors will be shielded so long as they were not involved in the diagnosis or the surgery or whatever. It was solely that other doctor, then they will be shielded from that liability. So you see the difference between a limited partnership and a limited liability partnership. In a limited liability partnership, you have basically 2 hats that you wear. The first hat is that of a general partner for the clinic, and the other hat is for a limited partner for malpractice. Or maybe we're architects. Same thing. We have an architectural firm. We work on different projects. So we'll have individual liability if we have malpractice for architecture or engineering or dentistry or lawyers. Any type of a service type professional activity, that's where you see these limited liability partnerships. Now, what if the medical clinic has 200 doctors? Obviously, that's not going to work very well in management because 200 people voting on something, it's just not efficient. So what we do then is we have a management committee made up of 3 out of the 200, the managing partners, and then the rest of the doctors are just going to be limited partners. They may share in the profits, but they're not going to be making management decisions. So you can be very creative in how you structure these type of limited liability partnerships, and they still are very common. You'll see advertising all the time. It'll say LLP, especially in you see it a lot in brokerage and investment company, houses and that kind of thing. And it's still a pretty popular form. But the problem is you still have a level of personal liability exposure even as a limited liability partnership. So let me just go back and contrast the two. Limited partnership, you have two distinct roles: investor, manager. No, you cannot manage at all. You do have management authority, but you have unlimited liability. Limited liability partnership, dual roles. Limited partnership, general partnership. Limited liability for the individual personal actions of the partners. Unlimited liability for the joint operation of the clinic or the brokerage house or whatever. Okay, see the difference? Now, back to my chart. Notice something. Which type of partnership? There are three: general partner, limited liability partnership. Of those, which ones have full limited liability for everybody? Trick question. Which one? None. Right? No type of strict partnership has full limited liability. There's always some exposure in a partnership, regardless of the type of partnership you have. As you work your way this way, there's less and less exposure. That's why I have this green line right here. On this side of the green line, unlimited liability. On this side, there is now more and more limitation or protection. But again, that's one of the big problems with partnerships, regardless of the form, general partnership, limited or limited liability partnership, there's always a level of liability exposure. Now again, you can manage that as best you can with insurance and best practices and how you do things. But again, at the end of the day, there's still that worry because you don't have a full liability shield like you do with a corporation or an LLC. So let's talk about them in terms of how they're structured. So now let's talk about the corporate model. So we're going to have a corporation here. It could be a C Corp or an S Corp. For purposes of this discussion, they're basically the same thing. So we're not going to really get into the tax side of things in this discussion. So let's say we have a corporation. So this is sort of standard corporate formation. Primarily, this is what you're going to see in a small or medium-run business. It may be different and publicly traded, but we're going to focus more on the small family-run business type environment. So let's just say we have a corporation and we have two owners. So in a corporation, the owners are called shareholders. So we have shareholder 1 and shareholder 2, all right? Now the reason, so the owners are called shareholders. In a partnership, the owners are called a partner, either a general partner or a limited partner. So let's say each shareholder has 100 shares of stock. They put money in, and in exchange they get shares of stock back in the corporation. S Corp, C Corp, same thing. Publicly traded, same thing. I go buy Apple stock, I'm now a shareholder. That means I'm a part owner of Apple, albeit a very small one. So the shareholders are the owners. Their percentage of ownership will depend on the number of shares that they hold compared to how many shares are outstanding. So in a small business like this, we have two owners. Each has 100 shares, so that's 200 shares of total outstanding stock. So they would each be a 50% owner, right? Whoops, 50%. All right. So as shareholders, as a shareholder, from a management standpoint, a shareholder only really has one area of management themselves, and that is to vote on the board of directors, to vote who will be on the board of directors. So basically, from a management standpoint, board of directors. And oh, by the way, I'm not going to make you diagram all this out for the test or anything, okay? Don't worry about that. I'm not going to make you write essays or anything. So the shareholders will vote at the annual meeting, or whenever there's a meeting called, special meeting, to vote on who will be the board of directors. The board of directors are the primary policy-making management structure of a corporation. Now typically in a big, publicly traded corporation, their board of directors are not going to be involved in day-to-day stuff. In a small business, you have two shareholders, they're also going to be the members of the board. So they serve dual roles. In a corporation, the shareholders will have limited liability. So if something happens wrong, the corporation gets sued, they may lose their investment, but that's it. So if I own Apple stock, or back in the day WorldCom, which went bankrupt, any money I invested by buying that stock is gone. However, that's the only liability, that's my only exposure, was the lost money I paid buying the stock. I don't have any other personal liability. So as a shareholder, you do have a liability shield for claims against the corporation. Then in terms of management, the board of directors will then appoint, I should put here vote, the board of directors will then appoint the officers. Which typically is a president, vice president, secretary, and a treasurer. So these are the officers. Under Oregon law, a corporation must have a president, a secretary, and a treasurer. Vice president's optional. Now, you may want to have other type of officers. So for example, maybe you want to have the day-to-day officers be the president, vice president, secretary, treasurer, but you might want to have in between here a CEO, a CFO, a COO. You might want to have a middle layer of officers, chief executive officer, chief financial, chief operational, whatever. However you want to structure your business. That's pretty common, but the most common form of small corporation that I see in my practice is president, vice president, secretary, treasurer. Now you can have any number of these you want. I had a client once that had like 18 vice presidents because they wanted business cards with each of them having a role, vice president of marketing or whatever. Another client I have, family-run business. The parents started the business, they're now backing out of it, but they still want to have control. So they've created the executive officer positions. So the dad is the CEO, the mom is the CFO, and they have overriding authority to veto whatever the other officers do. And then they made the daughter the president and the son the vice president. Kind of get the idea. So you can structure that however you want. What document will set forth those details? Talked about last week. Bylaws. The bylaws of the corporation will detail what officers you have, okay? And then from there you have the employees, the managers, and everybody else. So that's a typical corporate structure. Now from a liability shield standpoint, you have a shield both ways. So as an investor, you have a shield from your personal liability to the value of your investment. If you're on the board of directors or management, there's also a shield to a degree that protects you because you can make management decisions. And if the corporation gets sued, the corporation has to indemnify you, that is, pay for those claims. And so this is where we get into the idea of having the ability to manage but not have personal liability. In all the partnership structures and a sole proprietorship, if you have management authority at any level, you're going to have a layer of exposure of unlimited liability. So the idea of a corporation is you've got kind of two sets of liability shields. One shields the shareholders and the other shields the management of the corporation. And there's a reason for that. The corporation is considered a separate legal entity. This is called corporate personhood. You may have heard that term before, but it's more than just a corporation. In law, we have what are called juridical entities, which is a fancy way of saying a fictitious person, a paper person. I mean, literally, what is a corporation? Does it exist in the real world? I mean, it's literally a piece of paper, right? And maybe not even that, it may be a digital PDF. You know, it doesn't really exist. It's a legal fiction. But we have other type of entities in law. So we have nonprofits, you know, charitable organizations, 501c3s, etc. Those are nonprofit corporations. We have government entities, so you know, the university is an entity. We have religious and cultural organizations that are entities, unions, you get the idea. Clubs, you know, like Rotary Club and that kind of thing. So these are all juridical entities. And the idea of the entity theory is that the debt and claims, lawsuits, are against the entity, not the people that own the entity or manage the entity. So if a corporation enters into, let's say it's a farm, they want to buy a tractor for $300,000. They go to John Deere Credit Corporation, they get a loan, and the loan is in the name of the corporation, not the owners. And so if they default, the corporation is who owes that money, not the owners. Same thing with a lease or anything else. Now the owners may still be liable if they sign a personal guarantee. We talked about that, you know, earlier. I won't get into that today. So this is the standard structure I just want you to understand. Owners at the shareholder level, management, board of directors who are voted on by the shareholders, and then the board of directors can appoint and hire the officers that will run the actual day-to-day business. So that's the corporate model. All right, finally we have, and remember there's two types of corporations, S Corp, which is a small corporation, Chapter S of the tax code, single tax, and double tax for a C Corp, and we'll talk about tax forms next time. And finally, we have an LLC. So LLCs are fairly new. The owner of an LLC is called a member. LLC stands for Limited Liability Company. And when I say fairly new, they've been around since the 1990s, which is fairly new. Corporations have been around, again, going back to ancient Greece and Rome and all that. So an LLC, the idea of an LLC was to create a form of business entity that can be structured really however you want it. It's kind of like modeling clay, right? I can turn it into a car or an airplane or a boat, and I can mash it all together, or I could have a car with wings, a flying car. So the idea of an LLC is you can make it into really whatever you want it to be. And so that's both good and bad. The good part is it's very flexible, and you can really kind of take, on my chart here, you can sort of pick and choose which of these different attributes you like and blow it all up and put it into the form of an LLC. So LLCs, the way I look at them, have 4 different formats, or 4 different versions. You can have an LLC that's like a sole proprietorship. That's a one-person LLC. We call that a single-member LLC. It's like a sole proprietorship, only you have liability protection as the owner. Really common. If you're going to have any kind of business, it's going to be ongoing. Don't be a sole proprietorship. And if you don't want to be a corporation, be a single-member LLC. That gives you at least some personal liability. We have the general partnership model, where the owners vote their percentages like you do in a general partnership when you make decisions. But again, you don't have the liability problems because the LLC provides a liability shield right here. And so it's like a general partnership because you vote your percentages, but because it's an LLC, you have a shield. Works very well. We have a limited partnership model, and that's called a manager-managed LLC, where you have a manager, like you do in the apartment building, but the owners, the investors, can also vote on major issues. The manager does the day-to-day stuff, but if there's going to be like, okay, are we going to sell the apartment building? Then everybody gets to vote on that, and they don't lose their liability protection. So that's called a manager-managed. This is called a member-managed, manager-managed. And then we have the corporate model, where an LLC can actually act like a corporation, either a C Corp or an S Corp. Most commonly, I see this as an LLC that is treated as an S Corporation, which is very common nowadays. Even a one-person LLC can be an S Corp. And that way you can have a board of directors and do all that kind of thing like you do in a corporation. And also have some tax advantages of an S Corp. So at the end of the day, what I want you to know about LLCs is they're very, very flexible. The way that they're organized will all be set forth in, again, the operating agreement, which are like the bylaws. That's what we looked at last class session. All right, so we are out of time for today, so that's it.